So I know we already kind of visited this idea before, this idea of the money supply and the impact that that has on interest rates. We're going to revisit this graph, but we're actually going to look at it in a slightly different way. So not the exact same way before, but the concepts are all still there. When we talk about the supply and the demand for money, now we're going to not just talk about this in relation to our the quantity of loanable funds. Remember, we said the amount of loanable funds is determined by interest rates, which determines if consumers, people who hold money, will put it into banks or not, which will increase loanable funds or decrease the supply, whatever it might be. We're instead going to look at the money supply across the entire economy. And what we're going to see is the money supply across the entire economy. Right here, we're going to look at it as a vertical line because it is not subject to the interest rates, okay? It is going to stay the same. That's why it's a vertical line. But we're still going to see a downward sloping demand curve for money. And so this is the quantity of money across the entire economy, not just within, banks for loanable funds. We're just talking money as a whole, right? And we're going to have interest rates as the price of money too. So again, we're going to still have an equilibrium. And equilibrium, again, is the interest rate. It's that price of money, how much a borrower must pay back. But really, again, the law of demand plays in here. Interest rates are high. The price of taking out a loan is high. Whenever interest rates are low, the price of taking out a loan is low. And so we end up seeing law of supply still in action. But what we want to look at more specifically here is what we talk about when we say the Federal Reserve has the power to change the money supply and what exactly that does as a whole. Now, what you're going to see is it ends up having the same effect as we talked about that, like the loanable funds market, right? Where an increase in supply or decrease in supply changes that price. But again, we're not just looking at it specifically like at a specific bank. We're looking at it across the entire economy as a whole and what happens just when there's more money out there in general, okay? So when we look at monetary expansion, and what we're saying here specifically is whenever the Federal Reserve takes action in order to increase the money supply, all right? So that money supply line is going to shift to the right. The money supply across the entire economy increases. Well, again, what does this do? Well, what we see is that there's more money out there as a whole, including the money that's in banks, so that would include money in the loanable funds market. And so we end up seeing that drives interest rates down, right? Driven down as banks have more money to loan out because there's more money across the economy as a whole, including in banks. Therefore, the interest rates will go down. The price of money drops. We see that's going to lead to an increase in investment and an increase in not just investment spending, but even individuals' consumer spending as people take out loans, maybe for a new car or something like that. And then that leads to an increase in GDP. Because if you remember, investment and consumer spending are both part of our GDP formula. So if investment or consumer spending go up, GDP is also going to go up. So what I want us to see here is the idea that there is a direct relationship between an increase in the money supply and an increase in GDP. As the money supply goes up, interest rates are going to go down, which is going to lead to an increase in investment and an increase in consumer spending, which leads to an increase in GDP as a whole. But the same thing is true going the other direction. What happens if the Federal Reserve was to decrease the money supply? So they cause the money supply to shrink. Well, again, we see that movement from our original equilibrium to our new equilibrium. That's going to cause interest rates to rise. So if the money supply goes down, as we see there's less money out there, the price of money is going to go up across the entire economy, right? And so as interest rates go up, there's going to be less investment and less spending because it's now more expensive to borrow money. It's more expensive to invest. It's more expensive to take out a loan. And therefore, GDP will also fall. So there's a direct relationship between a decrease in the money supply and a decrease in GDP. Now, we talk about this because we say that one of the roles of the Federal Reserve is to control the money supply. But we're looking at this and we're saying, okay, like an increase in money supply or a decrease in money supply, how exactly does that happen? Like, does the Federal Reserve just drop money from a helicopter? Or if the Federal Reserve wants to decrease the money supply, who do they steal money from? And it doesn't exactly work like that. And so we need to make sure we understand how these changes in the money supply occur. So we saw before that expanding the money supply is going to increase GDP because of increased investment and increased consumer spending. At the same time, contracting or shrinking the money supply will decrease GDP because there's less investment and less spending. So therefore, as we would say, the Federal Reserve influences the money supply in order to help the economy recover from recession or recover from expansion. If our GDP is too low, they can expand the money supply. If our GDP, if we need to pump on the brakes, right? If we're in a period that we're beyond our potential, they can shrink the money supply. But how exactly do they do that? Well, we're going to look at 3 specific tools of the Federal Reserve of how they influence the money supply. And they can do that by changing the reserve ratio, by changing the discount rate, and through something known as open market operations.